Good day, everyone. For this session, we are going to continue our discussions, and this will be centered on the part two series of 2 over 2 for cash flows and capital budgeting. So, this is an extension of discussions of capital budgeting. Still, same source from Smart and Meganson. And the first topic is all about capital rationing. So if you say capital rationing, basically this is the process in which if there is limited capitalization or limited capital or sources of capital of a certain organization, so how can projects be allocated to such, or how will the capital be allocated to these particular investment projects or multiple projects? So in this case, we can ask ourselves, can a firm accept all investment projects with positive NPV? That could be one question. The reason that a company would not accept all projects is that what I've said could be capitalization. So financing may not be available for all projects. So that's the second one. The first thing, according to this source, although I would say that the second one really is my top consideration. If we say capitalization, that's going to talk about sources of financing, whether from debt or equity, of course. So debt is through bonds payable or equity is through issuance of shares. That could be one question. But the first one is limited availability of skilled personnel to be involved with all the projects. So meaning lacking skillful or skilled personnel or human resources, which is also true and very true, most especially if the project is really like worth millions and billions of pesos or dollars or any other currency, and that it must be needed that everything should be in place. So whatever issues that are needed and whatever resources that are needed, whether human or capitalization, should be answered respectively. So that's the reason that our answer to this question is no, that we would not accept all projects. All right, so companies are reluctant to issue new shares to finance new projects because of the negative signal this action may convey to the market. Right, so why are you issuing new shares? So you think that you need more capital because you are issuing or you're into another issuance of shares or authorization for issuance of shares. So why are you into that? Isn't it that your company is successful? That's why you have the capitalization now. So that could give negative signal to the market, although not all the times. All right. Then capital rationing is project combination that maximizes shareholder wealth subject to funding constraints. So again, there is capitalization constraint or limitation. So how do we do that? Remember in the previous chapter, we already computed one way of or one method of assessing whether we accept a project or not, and that is through profitability index or PI. And then so that is the reason that we have to go back into such item or way of, again, assessing of acceptance or rejection of a project. Number two is that we have to select the investment with the highest profitability index. And then if funds are still available, so select the second highest. So that's why there is a need again for ranking of the said projects through profitability indices. And so on, continue the ranks until the capital is exhausted. So it follows that if ever there is really limited capital and then let's say the remaining capital cannot really answer the next in line, or let's just say the remaining capital is less than what should be the capitalization on the next project. So it follows that such funds would be treated as extra. All right, so the steps above ensure that managers select the combination of projects with the highest net present value. So remember that the net present value is basically the difference between the present value of cash inflows and the cost of investment. And the PI is just the ratio between the present value of cash flows and the cost of investment. So net present value is very closely related to PI. In fact, if you have computed the NPV, so by utilizing the given items, just the PV of cash inflows and the cost of investment, then you will get what you are looking for. All right, so example would be a firm must purchase an electronic control device. So first alternative, let's devise a cheaper device, higher maintenance cost, shorter period of utilization. Second device is more expensive, smaller maintenance cost, and longer lifespan. Of course, normally this is the case that price commands quality, which is traditional in nature. Although this may not be true all the time, especially nowadays, but traditionally speaking, if you say quality products, normally the prices are higher, and in terms or in terms rather of maintenance costs, they are actually going to involve lesser or smaller amount, and the lifespan would be longer. Okay, so you can notice the cash outflows for devices A and B. So at time 0, 1, 2, 3, and so on. Then let's check the total though. This is 4, 5, and then this is 4, 8 for letter B. Okay, and then 4, 1, 2, 3, and 4. But if we add now here, so this is 16,500. This is 18,800. Okay, so using real discount rate though, it seemed that B has higher, but using real discount rate, so we can compute that the net present value of A and B would be for A 15,936 and B 18,065. So device A's cash outflow is lesser than device B's cash outflow. So we have to use A. So select letter A. Even prior, so it seems that A has lesser, B has more, and then the more with the discounted cash flow. So select A. Next, for application of capital rationing and the profitability index with 12% required return. So if we compute, for example, for years 1 to 4, using the discount rate of the 12% as given, then we have to multiply that to the respective cash flow. So example, for 30, that would be multiplied by the quantity 1 plus 0.12 to the power of -1. And then for year 2, it's -2, and so on and so forth. So we get the present value of cash inflows. If we deduct such to 70, then we get $59.2 net present value. And that's net present value. What about the IRR? Well, this is again a matter of interpolation, or we have to estimate. But basically, the IRR is the rate by which the present value of cash inflows will be equal to cost of investment, meaning the NPV is 0. While the PI is whatever was the present value of cash inflows divided by the cost of investment 70, that's 1.8. So with this NPV 59.2, I will work back 59.2 plus 70 cost. So that's 129.2. That's the present value of cash inflows. 129.2 divided by 70, that's 1.85 if 2 decimal places, if 1.8. Okay, and so on. So you can notice that if you rank this one, this is 1. The second would be these 2, then third and fourth. So what about for these items? All values are outflows for operating and replacement cash flows for 2 devices. So probably the amounts here are going to be negative, right? So negative NPV. And then we have to consider the lesser amount. Remember, if we do this mathematically speaking, the lesser amount or value, basta negative, or if ever we're talking about negative, then that's going to be our consideration. So that's why we can see it here. You can see it here that we select A because it is of a lesser negative value or amount. All right. So that's why for this also, we are going to consider the lesser, which is B. Okay, then another item is equivalent annual cost or EAC, wherein this can convert lifetime cost to a level annuity, or meaning equivalent annuity or annual amounts, and eliminates the problem of unequal lives. So example, for device A and B, we compute the NPV. We have done that already in the previous slides. Then we can compute the annual expenditure or annuity cost to make the NPV of annuity equal to the NPV of the operating device. So what do you mean by that? The NPVs were already computed. So the question would be, what amount of the annuity in which, if we are going to discount, that would be equal to the given NPV. So probably the solution here would be that we can compute first the present value of ordinary annuity of 1 for the 3 items. So we can just compute this. This is like PV of 1. So it should be PV of ordinary annuity of 1. And that is, the formula is 1 minus the quantity 1 plus I to the power of negative n over I. So if you don't like that, you can just follow these 3 and then get the total, and then let X be the annual expenditure. So whatever is the total of these 3 divided by 15,936, you will get 6,072. And this is the same for the 3 items, or rather 4 items for the second, 3 for the previous or prior. Okay, since devices B annuity cost is lower, then we have to choose device B. All right, so this is now the continuation of the analysis, because initially, if we can just go back, we mentioned that we are going to select this one. We have to select A initially by just this particular analysis of NPV. But then if we use the equivalent unit cost now as an approach, so we are going to select B because it has lower annuity cost. Next, excess capacity. So this is not a free asset as traditionally regarded by managers. If we have some capacities which are unutilized, and then there are opportunities to earn, normally these particular excess capacities are going to be treated as opportunity costs. Then we have an example. Company has excess capacity in a distribution center warehouse. In 2 years, the firm will invest $2 million to expand the warehouse. The firm could lease the excess space for $125,000 per year at the beginning of each year for the next 2 years. So this would involve annuity in advance. Or if we wouldn't like, so we can just have it like we count the first annuity at the beginning as 1, and then the next would be wherein we are going to compute the present value. So meaning the first one would be just 1, and then the next would be 1, and then plus n to the power of negative 1. All right. Expansion plans should begin immediately, in this case, to hold inventory for new stores coming online in a few months. Then incremental cost, investing $2 million at present versus 2 years from today. So there is a comparison. If we invest the $2 million to expand the warehouse at present, or it will be versus 2 years from today. And then incremental cash inflow would be the rental estimated. Okay. So the NPV of leasing excess capacity, then that would be the 125,000. That's what I've said. This is at the beginning. And then at the end of the year, so divided by 1.10, then minus 2 million. Let's go back to the problem. So 2 million, the firm will invest to expand the warehouse. And then Later on, that's going to result at the end of 2 years. So the cash inflow for this one. So 2 million divided by 1.1 squared. So we'll get in PV of this particular amount negative value, 108,471. What about if we reject leasing excess capacity and we get 125,000 per year? So that's going to be negative NPV then for this one. Then the firm could compute the value of the lease that would allow break even. So break even meaning the two options would be equal to each other's NPV is zero. What would be the X amount that would be replaced, or that can be replaced to 125,000 to basically break even? So per computation, that's 181,818 at the beginning of the year. So leasing the excess capacity for a price above this amount would increase the shareholders' wealth. So this is the lesson about excess capacity. Some might wonder, why is it that there is 2 million pesos here treated as an inflow? So aside from the outflow here, of course, outflow is clear. Inflow could be a question. Well, the assumption here is that the 2 million pesos will be a certain inflow at the end of 2 years. If we go back to the problem, so it says here in 2 years, the firm will invest $2 million to expand the warehouse. So this would be a certain investment. So it would be an amount that would be treated as an outflow and also an inflow. Okay, then another one or and that is the human face of capital budgeting. So managers must be aware of optimistic bias in the assumptions made by project supporters. These particular supporters, or the ones organizing, crafting, creating the projects, might be making assumptions which are optimistic or positive, and sometimes could be overly optimistic or positive. It's okay to be positive though, or optimistic, but it might be already on unrealistic terms. So that's why managers must be aware and cautious about these. Companies should have control measures in place to remove bias. So investment analysis should be done by independent group of people. So the group independent of those the ones proposing the project. Project analysts must have a sense of what is reasonable when forecasting a project's profit margin and its growth potential. Because sometimes again, optimistic biases could be there. And then storytelling, the best analysts not only provide numbers to highlight a good investment, but also can explain why the investment makes sense, aside from the computations shown, so they can give the story behind the numbers. Then to summarize, cash flow and capital budgeting would, of course, involve the certain types of cash flows, which are common to many investments. Opportunity costs, which are benefits foregone in choosing certain alternatives over the others, or options or choices, should be included in cash flow projections. Also, we have to consider human elements or factors, especially the over optimistic or even plain optimistic biases towards the projects by the project supporters. All right. So this ends part two of our discussions about cash flow and capital budgeting. God bless.